With the year 2022 coming to a close in less than 2 months, what we've been experiencing in the markets this year can be described as truly chaotic. Coming out of the COVID pandemic along with supply chain issues, high inflation, and the war in Ukraine have resulted in us seeing some extreme market volatility and dramatic share price drops this year. When it comes to all the higher yielding stocks and securities we look at on this channel, there's been one sector in particular that's already been taking a serious beating. Not just in share price declines, but a handful of these companies have already experienced dividend cuts. For dividend and income investors, a dividend cut is more serious than a temporary drop in share price, because some people are currently living off of their dividend distributions, so a dividend cut can result in them having to reduce living expenses. What's worse is for certain types of investments, once a dividend cut occurs, it can be years and years before the company can potentially rebuild its dividend back to what it originally was. But out of all the types of higher yielding investments, including business development companies, equity REITs, master limited partnerships, closed-end funds, royalty trusts, and exchange-traded notes, the one sector that's taken the largest beating of them all is mortgage REITs. Even with the recession still officially months away according to some analysts, we've already been seeing some weaker and poorly run MREITs start to buckle and already cut their dividend distributions this year. Some have gone through reverse stock splits, and the majority of these types of investments have also seen their share prices fall harder than the S&P 500 this year, which makes things even worse. If you watch my channel on a regular basis, these MREITs that have seen their dividends get reduced this year will be names you've never heard of before. But the two MREITs that have gone through reverse stock splits are companies that I've been critical of for a long time. In reality, I've been critical of most mortgage REITs since the beginning of my channel, and I've had a strong dislike for the majority of these types of companies for years. But it is true that not all MREITs are bad, as some are much better performers than others. The truth is that the way these companies are structured, a large number of them are much more prone to dividend cuts during rougher economic times like what we've been going through this year. One of the most serious dividend cuts we've seen from a mortgage REIT in the last month was by Invesco Mortgage Capital, ticker symbol IVR. On September 28th, the company announced that they were cutting their dividend to 65 cents per share, which is a 28% decrease from the previous quarter's 90-cent dividend. Having been founded back in 2008, the company got absolutely demolished during the COVID pandemic, where it lost 84% of its value in less than a month. It's a pretty tragic situation because between its IPO up until 2020, the share price had remained pretty consistent. Then in just a matter of weeks, it lost over 80% of its value and it never recovered. Odds are the majority of people who invested before the pandemic lost pretty much everything on this stock. Another serious dividend cut came from Chimera Investment Corporation, ticker CIM. Much like Invesco, Chimera is a mortgage REIT that took a beating during the COVID pandemic and it's never been able to recover. On September 21st, they announced a 30% cut to their quarterly dividend. Instead of paying 33 cents per share, it was now paying 23 cents per share. It had looked like the company had been in the process of trying to regrow that dividend back to its pre-pandemic amount of 50 cents per share, but with news of a dividend cut, the odds of the company being able to get it back to 50 cents per share seems pretty grim, at least anytime soon. And then the two mortgage REITs that recently went through reverse stock splits are Orchid Island Capital, ticker ORC, and the largest mortgage REIT in the industry, Annaly Capital, ticker NLY. In the last 2 months, both of these companies have performed a reverse stock split, with Annaly holders getting a 1-for-4 deal and Orchid Island holders getting a worse deal at 1-for-5. This resulted in the share price of both companies increasing, which were pretty much at penny-level stock prices. Both of these companies have been performing terribly for a number of years, and particularly with Orchid Island, there's virtually no time in this company's history where an investment in this company would have made you a positive return on your investment. I went into more detail on the reverse stock splits in a video I made last Tuesday if you want more information on this. Another mortgage REIT that hasn't seen their dividend get cut this year, but I think is in some really hot water, would be New York Mortgage Trust, ticker NYMT. Just a few days ago, their stock share price fell to just $2.08 per share. A decreasing book value is the main culprit for this stock trading so low, and if this trend continues, this stock might be completely delisted from the Nasdaq. In order for that to happen, a stock has to trade below $1 per share for 30 days. If that happens, the New York Mortgage Trust will get booted from the exchange, which obviously won't be good for the company's future prospects. I also want to mention that there was actually one equity REIT that I discussed on this channel before that has seen their dividend cut this year. Generation Income Properties, ticker GIPR, announced a dividend cut 2 weeks ago on October 4th. I only discussed this stock one time on this channel, which was in the every monthly dividend paying stock video. Fortunately, I've never been invested in this REIT because GIPR has one of the smallest real estate portfolios out of any publicly traded REIT. This company only has 13 properties, which is pretty small compared to, say, Realty Income's 11,400 properties. Despite having a 100% occupancy rating, I figured that if just one of their tenants decided to move out, then it could cause a lot of chaos for their dividend. So what lessons can we learn from these dividend cuts, and what are some better investments during periods like we're going through? First off, all of the mortgage REITs we looked at in this video were offering dividend yields of over 20%, with Invesco Mortgage Capital actually offering close to 30% when their dividend cut was announced. This reinforces the most important rule for dividend and income investors, which is that it's a really bad idea to pursue investments simply offering the highest dividend yields. Even with so many stocks trading at huge discounts, if any investment is offering a dividend yield of say over 10 or 12%, then it should be met with extreme skepticism. If a dividend yield looks too good to be true, then it most likely is. Secondly, out of all the high-yielding dividend stock sectors, mortgage REITs are probably having the roughest time out of everything else out there. They're financial businesses that provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities and earning income from the interest on these investments. MREITs fund these investments with equity and debt capital, and their goal is to earn a profit from their net interest margin, or the spread between the interest income on their mortgage assets and their funding costs. As you can imagine, with rising interest rates this year, things have been pretty awful for the majority of mortgage REITs. The companies that have it worst are those that only invest in mortgage-backed securities instead of issuing their own mortgages. Like I mentioned in my previous video, the kinds of MREITs that focus on mortgage-backed securities have been suffering the worst, including Annaly, Orchid, Chimera, and Invesco. MREITs that issue their own mortgages or invest in mortgage servicing rights or own both mortgages and physical real estate have typically fared better over the long term. If interest rates keep going up, then the previously mentioned companies will probably continue to suffer going forward. With this in mind, what are some good dividend investments to make in our current market, especially if you're worried about dividend cuts? The first type of investment that's good in all situations, and in fact even more so in our current market conditions, are dividend growth ETFs. Earlier in the year, the Charles Schwab Dividend Growth ETF, which is ticker symbol SCHD, was only yielding around 2.75%, which isn't particularly exciting for people seeking higher yields. But now that SCHD is yielding close to 4%, it's an even better deal right now. Over the last decade, this ETF has provided consistent dividend growth, which is something that every portfolio should have, even if you only like to focus on income investments. Another good type of dividend investment if you're worried about dividend cuts would be to look at stocks that are dividend aristocrats, kings, or zombies. These are stocks that have consistently increased and paid out dividends every year for at least 25, 50, and 100 years respectively. Just like with SCHD, these types of companies usually offer much lower yields, which aren't too exciting for people looking for income. I'd say that most offer yields around 1 to 3%, which is pretty boring, but given how much the stock market has fallen this year, we've seen some of these types of stocks with decades of solid dividend growth now offering 4% or higher dividend yields in certain situations. It's still important to do research before investing in any of these types of companies, as we still all remember how AT&T cut their dividend despite being a dividend king. But stocks in these categories are typically much safer. AbbVie is a dividend aristocrat that's still yielding over 4% as of the making of this video, and it's actually up for the year slightly. My favorite monthly dividend stock, which is also an aristocrat, is Realty Income, which now offers a yield of over 5%. It's a REIT that's continued to grow their dividend every single quarter since being publicly listed back in 1994. If you're still seeking higher yields and are concerned about dividend cuts, it's always a good idea to go with business development companies, master limited partnerships, and closed-end funds with long, solid track records of performance. For example, when looking at business development companies, Main Street Capital is a company that's made it through the financial crisis and to date has never reduced their dividend. Plus it pays monthly dividends, which is always better in my opinion. Another BDC with a long track record of performance is Ares Capital, which is one of the oldest publicly listed business development companies still out there. The good news is no mainstream large equity REITs, BDCs, closed-end funds, or master limited partnerships have announced dividend cuts as of recently. It's an issue that as of right now is only impacting mortgage REITs for the time being, but it's important to keep in mind that dividends are a lagging indicator. Because most companies report earnings only every 3 months, we don't know what the future is going to look like as we go into 2023 yet. Regardless of what happens, it's important to stay calm and remember that eventually the market will go back to growing and will eventually soar higher than it ever has before. This is what's happened after every single bear market that we've ever been through.